Okay, welcome to the Airme Roundtable. Today is the 20th of November, 2020. So welcome. I have a special guest, John Locke. John and I go back a long time, and it's always a pleasure to have you on, John. And I'm sure your topic will be interesting for everyone.
Thanks, Tom. Appreciate it, and appreciate everybody coming and listening to the presentation today. So I want to just get rolling here. We can do that. So today I was going to talk about trader transformation principles, and we'll talk about what that is as we kind of get into the presentation here. But before we do, just like to remind everybody that this presentation is for educational purposes only. We're not broker dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. If we do any trades here today, consider them hypothetical computer simulated trades and results. They would be believed to be as accurately represented as possible. Keep in mind that live results can vary from simulated results for many different reasons. All right, so for those of you who may not be familiar with me, I'm John Locke. I'm a trading performance coach. I help traders create a reliable income through options trading. I have a website, lockeinyoursuccess.com. It's also a business. We do sell trading strategies, but we also sell trading performance strategies, which is, I find, much more important in helping people become successful. And we also have memberships and so forth on our site. We have multiple free resources that you guys can check out. If you go to thewinningtrade.com, that shows some of the different trading strategies that we have. And we have something called tradingperformancepodcast.com, which relates to trading psychology, and a lot of information there on how to improve your trading performance. And our YouTube channel is lockeinyoursuccess.com, or youtube.com/lock4success. And then, of course, our website is lockeinyoursuccess.com. So we have a lot of good information there. So as we move along here, let's just talk about trader transformation principles. Actually, before we do, anybody, I like interaction, so I love interaction. So feel free to ask questions. I don't really care if I get off topic, as long as we have something good to talk about for the next hour here. So this presentation is going to be about trader transformation principles. It's a brief overview of two of the many principles that we covered in our trader transformation workshop that I did last year, which was a 2-day workshop about how to transform yourself into a competent, confident, consistently profitable trader through developing the proper mindset and through gaining a full understanding of risk, reward, and probability and how they relate to one another, and what we call utility dynamics, which they use in gambling terms, and through learning how to quickly evaluate trading strategies, as well as how to create extremely effective trading strategies without having to spend hours upon hours back-testing them. In fact, one of the things that we do during the workshop with the students is I literally create effective trading strategies in a very short period of time. And some of the strategies that we actually did at the workshop, they were so effective that 3 of them came out of the workshop, and they're strategies that we developed in less than 4 hours, and they're powerful enough or profitable enough that I've actually integrated them into the programs, and we track them on Options Trading for Income, our Monday morning webinar, and they did fantastic in 2020. So 2 of these strategies, like I said, are an Options Trading for Income. Another strategy Seth is doing from SMB in his program. So really great strategies there. So you might ask, how could somebody possibly develop a trading strategy in less than 4 hours, including any testing they're doing, and be confident enough to trade it publicly in a 2020 environment, right, where the market's just crazy, doing things that it's never done before? And if you've ever been to one of my seminars, you've probably experienced me playing what we call stump the chump, with me being the chump, right? Basically what happens is one of our attendees gives me a trade or a set of rules that I've never tested perhaps, and sometimes I've never heard of. And then they give me a start date, and I have to tell them the result of that trade, or I have to put that trade in an environment where it's going to do well, or put that trade in an environment where it's going to do poorly. And there's just amazement when I do this, and with the accuracy that we hit with a trade, especially if it's a trading strategy that I've never looked at before. Now, when I do this, this isn't a trick and it's not magic. It's simply the result of having a full and complete understanding of our options configurations, and is how certain strategies and adjustment strategies and exit strategies interact with a particular type of a marketplace. What I'm trying to say is that what I do in the webinars or in the seminars, anybody can learn to do. And part of this seminar was teaching traders how to do this. So with time and effort, really anybody can simply analyze a trading strategy and determine the viability of that strategy. And they can do that without having to back test it for 10 years. And the problem though, or I could say, but, right, this can only be done if the trader decides to stop chasing after the next best trade, right? Which is what most traders do. They're chasing the next best trade, and not really learning anything. So in order to learn something, you need to start paying attention to what's in front of you with whatever strategy or type of trading you're trading, and then learn how it applies to the marketplace, okay? So why should anybody care whether or not they could simply look at a strategy and determine when it will do well and when it will do poorly? Well, there are multiple reasons why you might want to do that. The number one would be it's going to save you a ton of time, right? Think about how much time you spend back testing and fine tuning strategies. It's an insane amount of time for some people. And the reality is it doesn't really do them any good, because they back test it and they fine tune it so that it form fits the past and that it worked out okay. And then they bring that strategy into the future, and yeah, it might do okay for a period of time, but eventually something in the market changes or the timing's a little bit different in the future. And then next thing you know, you're back to square one and you go back to doing this thing when you're developing this strategy forever, right? That's not a very effective way to do things, but that's what people do. The other thing it'll do is it'll allow you to watch trade presentations of seemingly perfect strategies, right? They always work out perfectly when the presenter's doing them. But it's up to you to realize when that strategy is going to fail, or understand when that strategy is going to fail. So doing this will help you be able to pinpoint that really, really quickly. In fact, I'd say go so far as to say you'll often know more about the future performance of many of the strategies you'll see just by looking at the rule set and running through a couple trades than the developer himself will do, because most of the time the developer of that strategy, what he did is exactly what we were just talking about. He went back and he form fitted some sort of a strategy to the past, and we all do this. I do this myself, right? So to the past, without really understanding that he did that and how things might be different in the future, right? So the difference between the guy who's looking at the trade and what we would call, I guess, a real or a competent trader is that he understands that this strategy that he back tested, that he fine-tuned to the past, isn't going to necessarily work that way into the future, right? So that's a very key distinction that people need to make. Now, this process also allows you to know when it's best to use or avoid certain strategies. It allows you the skills to adapt strategies real time to changing market conditions. But most of all, it'll allow you to be a confident, much more consistently profitable trader. So one of the challenges that traders have is they don't have a confidence level in their own abilities. So what they do is they'll go and create a strategy or buy a strategy or whatever, and they'll form fit it to the past. So in other words, make all the right decisions at the critical moments for the purpose essentially of giving themselves the confidence that this strategy is going to, I guess you call it, work, and with the assumption that it's going to work into the future. And if anybody's ever done that before, we know that, yeah, we may have some profitability in the future, and it may be an excellent trading strategy, but it doesn't have the perfect performance that it's had in the past. And this is because, well, the future is different than the past. The timing is different than the past. The adjustment that you made at 12 delta, on your back testing, that same adjustment, and you made it at exactly 12 delta because at 15 delta you would have had a problem, and at 10 delta you would have had a problem. You didn't have it at 12, so you adjusted exactly at 12, right? That's what fine tuning does. And then they expect that to work into the future. That's not how it works. Like I said, future timing is going to be different than your past timing. So the trading strategy is not going to perform the same way into the future. But what will happen is traders will use that for their confidence. And the problem is when they use that for their confidence, when the future is different than the past was, and they experience maybe a few more losing trades than they would have otherwise, that crushes their confidence level. Right? So then they start doing things like dropping trading size or switching trading strategies. I mean, it doesn't mean anything's wrong with a strategy because it loses from time to time, right? So, even for multiple months necessarily doesn't mean there's necessarily anything wrong with the strategy itself, but the trader's confidence level is going to be all over the map, right? Because like I said, he's relying on this for confidence and now it's destroyed. So now he has to go back and do the same thing again through the same period. Not for the purpose of learning necessarily, but for the purpose of building his confidence back up so he can trade it again with the same result in the future. When the timing of the future changes or something's different in the future, then they're in that shock state again. So this is a cycle that traders go through for many, many years. But we're trying to break that here. So I didn't mean to get off on that tangent, but that's something that I think is important. But anyway, knowing or understanding these strategies at a really deep level and how they interact with the marketplace, it's going to allow you to be confident. Now, truly confident, right? We call fake confidence something outside yourself. True confidence or self-confidence is understanding what's going on, understanding when what you're doing is probably not the most beneficial thing to do, and then knowing what to do about it to better interact with the marketplace. So we can do that by understanding these strategies. Now, I'd go as far as to say that your ability to understand trading strategies at the level that we're talking about is literally the key to becoming that confident, consistently profitable trader that most people are looking to do. So what we're talking about is extremely important. But the first question I get, right, is how do we understand strategies at this level? People think they understand the strategies, but when I work with them, it's obvious that they don't, right? So, but how do we develop this kind of a strategy? So this is the first principle we're going to talk about, is fully understand your strategies. So I'm just going to start with something really simple, right? If I were to buy 10 shares of SPY and exit 30 days later, and I knew what the entry date was in the past, right? Say I was going to do this sometime in the past, and I knew what the entry date was, anybody would be able to tell me how much that trade made, right? If I tell you I bought 10 shares of SPY on September 1st, and I sold it on September 30th, you would be able to look at a trading chart and tell me whether I made money or I lost money, and you'd be able to tell me how much money I made. This is the level that you should understand your trading strategies with. If I were to tell you that I put on, one of the strategies we have is an M3, and I put it on, I started on this date, you should be able to, and you look at the charts, you should be able to tell me what happened. You should be able to tell me how much that trade drew down with very close accuracy, whether that trade won or lost money, what were the positionings on that trade. All that should be able to come out to you, right? It's something that takes practice, but we should understand our trading strategies at this level. You see, what happens with most people is they put a strategy in backtester and they convince themselves that essentially it can't lose or it can't take a big loss or it's going to have a certain win rate, and which anybody can do through form fitting it, right? They convince themselves of that, and they hide their losing scenario from that strategy for themselves. In other words, they don't know what has to happen. I mean, they know some things that might happen. I mean, they might know that if you get a 100-point down move right away, that the strategy might lose, but they don't know when we start getting into the more complex stuff. They don't know that a movement at this point in the trade, or if you have a rolling strategy, if I have to roll, what's the new losing scenario, right? So we have a trade entry that has a certain winning and losing scenario. We have a series of adjustments that we apply to that strategy, which will change our winning and losing scenarios around, right? And then we have some sort of an exit criteria, which also defines our winning and losing scenarios. And when certain things happen, when there's going to be a problem, when there's not going to be a problem. So all these things, and some people have scaling, and some people have time overlap things, and some people have price scaling things. And all of these factors affect the type of market environment a particular strategy is going to do well in, and when it's going to do poorly in, right? But when we develop a strategy, we try to do it for a very wide variety of marketplaces, and we can trick ourselves into thinking that it's just, hey, this is the perfect thing, right? This is just going to be profitable all the time, with maybe a loss here or there, without really realizing what they're doing. In other words, they're trading with kind of purposefully ignorant of the losing scenario of the strategy. So we don't want to do that. So this is the level. Now we start with that, right? And then if you go to the next level, right, we can add some strategy into our trading strategy. We can buy 10 shares of SPY when the 20-day moving average crosses over the 50-day moving average. And we can have an exit point of selling at either $100 profit or $50 loss, right? We throw some more parameters into the trading strategy that we were just talking about, right? So we could do the same thing, right? Because it's pretty easy that you can look at the 20 and 50-day moving averages. You can see when they cross, so you know when the person entered. You know how much that trade is up or down at any given time, given the price movement of the SPY, and you can tell if that trade was stopped out before it hit $100 profit, or if it hit $100 profit and exited, or maybe you're still in the trade because it didn't lose or gain $100. So again, you can do that, right? So we're adding some criteria in, and we can tell what the result of this trade was. So then, right, we can take a look at a bullish vertical, right? So you can do the same thing. You can say, we did we sold a bullish put vertical, for example, and you can say that, and you should be able to look at the price chart, and if you fully understand that strategy, you should, say we do it without an adjustment criteria, right? It's just a bull vertical. You should be able to get an idea of implied volatility based on the price movement before you entered, right? Markets that have a very high ATR and large price ranges are going to have a certain implied volatility and profile and IV skew curve that's going to give you either more room or less room to the downside, right? And then depending on whether you get a range expansion with a down movement or a range contraction with an up movement, that's going to affect the implied volatility of the trade, and that's going to either make you or lose you money through the implied volatility dynamic of the trade. You also have a time dynamic, which is interlaced with the implied volatility dynamic, and then you have the price direction movement, right? So if you understand what implied volatility does to a bullish vertical, you can understand or get a good idea of, perhaps you had a down move and the trade was up money, because that can happen with implied volatility, right? So, but it gives you an idea of how that trade is going to work out simply by looking at the price charts without doing that. And then from there, we can start adding more and more criteria to it. We can say, okay, well, that's how a bullish vertical reacts. Now, how does a butterfly react? How does a broken wing butterfly react? Can I understand this broken wing butterfly strategy and understand when it's going to win, when it's going to be problematic, given the price movement and the applied volatility in the structure. And then we can start adding in adjustments, right? We can say, well, I started out with a broken wing butterfly, and now I moved my upper long down. Okay, so to the up move, how does that affect the dynamics of the strategy and the winning scenario to the upside, the winning scenario to the downside, or the losing scenarios in either direction, and the profit and loss of the trade? So we just bring more and more dynamics into it. You get more and more complex, and at some point, you get a really, really full understanding of what's going on in the strategies. It takes some time, it takes some work, but this is where the key is. So we gradually layer in more and more levels of understanding, and more strategies. So I suggest that we do that. So let's see. Okay, this is just talks about the workshop. During the workshop, we literally created strategy. We talked about all this, right? So we talked about you do a bearish butterfly. We enter a bearish butterfly. What's the dynamics of that strategy? In other words, if I'm in a bearish butterfly, I don't know if people know this strategy or not, but it's essentially a butterfly that's put on 20 points below the market. And then as the market goes up, you put on another butterfly and then another butterfly till you get to 3. And then you're going to roll that butterfly. So, early on in that strategy, we have a $50,000 planned capital, a $15,000 maximum loss, say, right? So 30%. Early in that trade, you have a small amount of capital in it. Really, the market can't hurt you as far as going past a maximum loss number. A lot of times that strategy will not even be capable of stopping out in 1/3 of a position because it doesn't have $15,000 in it yet. But that's going to have certain dynamics to it, right? That 1/3 of position. As we scale in, we add another third of a position. That's going to change the dynamics of the strategy a little bit, not a lot. As we continue going, we have 3/3, right? So now we have a much bigger size. So now implied volatility starts to become more of a concern and things like that, right? Because now our size is big and now we have a lot of capital in the trade. If the market keeps going, we start rolling. When we start rolling and we get drawn down, now we have different concerns. So for example, this strategy is very resilient to very large price movements early in the trade. So if I enter the strategy and I get a really humongous price movement, generally it's not going to bother me very much. It's not going to be a big deal. But if I'm into the strategy and I'm rolled up 3 times and I get a really big price movement, that's going to be the kiss of death for me, right? That's going to be the losing scenario in the strategy. So when we think about the marketplace, what we want is we want a large move early on, and then we want the market to settle, because we know the market tends to make large moves and then settle, large moves and then settle. So we want to get we want that large move early on when the price is dynamic, and we want the market to settle out later in the trade. If the market dynamics are different than that, where we're getting entries during the quiet period before the breakout. I mean, you guys do a lot of different webinars. I don't know if you have John Carter on yet, but the squeeze play, right? So they consolidate for a while and then they take off. You don't want to be in a bearish butterfly and have the market sit and do nothing for the first 35 days or 40 days and then have this really big move in really either direction, because that's going to be the problematic scenario for the strategy. Okay, and people don't think about how that plays out. They just think, look, bearish butterfly, it's okay in a down move, and that's completely not true. That's completely not true. So if you understand the strategy at the right level, then those dynamics start to come into play. All right, so let me see where we are. So what we're trying to do is trying to create talk about the art of creating adaptable, non-subjective trading strategies. So by adaptable, I mean trading strategies that are traded differently depending on what their entry configuration looks like. So in this program, we really didn't focus anything on charting per se, but we focused on just the dynamics of different trading strategies. We talked about the principles and features of trading strategies, such as the Bearish Butterfly, which we just kind of touched upon now, right? Remember, this was 2 days. The M3, the rock trade, the bull trade, the Super Bowl, the net zero, and a lot of other trades that are out there, right? Rhino and stuff like that. We talked about all the principles underlying those strategies and why. What types of market situations are good for these strategies, and what type of market situations where you want to really tend to avoid the strategies. We talked about the phases of trading strategies and how the phase you're in affects the way the trade reacts, right? So phases of trading strategies. What do I mean by that? Well, we have an entry phase where we enter early in the trade. We have a middle phase, we have an end phase, which is your end game and your exit strategy. We have that as far as time goes. We have phases as far as adjustments go, right? So we might have a scale in trade, right? So like we just talked about with the Bearish Butterfly, phase 1 is 1/3, phase 2 is 2/3, phase 3 is 3/3, phase 4 is when we start rolling. And we might have that applies to an M3 also. You might have a trade that scales in by time, for example. And again, that has different phases and different vulnerabilities depending on what phases it's in. So we talk about or we teach about that thing, and we talk about how the right thing to do in one phase of a trade may be the wrong thing to do in another. Okay, and that helps you become more understanding and more adaptable. Also, we talk about how trade reactions and expectations should be changed based on the phase of the trade you're in and the adjustment features that were triggered during the trading campaign. So we have different phases, we have different adjustment triggers. When adjustment triggers are fired on your trading strategy, it's going to change the dynamic of that strategy. And again, everybody's looking for the one adjustment that is the best adjustment at all times. But the reality is that's the trading is not like that, right? Trading is very different. So trading, it's not going to be the trading adjustment. It's going to be, you're going to have to take a look at the marketplace and make a judgment. In other words, understanding what that trading adjustment does to the strategy, taking a look at the marketplace and deciding whether or not that's the best thing to do, or perhaps a bad thing to do, because something that's very good to do in one set of circumstances is often very detrimental in another. So it's very good to understand that stuff. I just noting here the trading strategies that we actually developed in Trader Transformation Workshop. We have an M3.4U, we call it. This is a strategy, which, by the way, we're actually having a presentation on the M3.4U this afternoon. So you can come over to lockingyoursuccess.com and get signed up for that if you'd like. But the M3.4U we decided to use as our core. We developed it in Trader Transformation Workshop, and the back testing and everything on it was done afterwards, with virtually no changes, by the way. But we did that, and we've decided to make this the core trading strategy of our Trader Success Blueprint that we have in our membership for what we call phase 3 traders. So it's ended up being a really great strategy. It's pulling 65% this year on closed trades, doing very, very well. Another strategy we did was the Super Bowl, which is 249% in 2020 on closed trades. And then, of course, Seth's short-term vertical strategy, which I don't really have any idea what the actual return is on that, but my guess is it would be very, very well this year based on what I know about it, but I haven't actually tracked it, so I can't tell anybody. So these were things that were developed in a very short period of time and later back tested, okay? So we're going to talk about the story of a strategy. A lot of people think that they trade non-subjectively. Okay, in other words, I trade non-subjectively. I don't care what the market does; it doesn't make a difference. I'm going to put this strategy on. And if you're truly into trading or a good trader, you shouldn't be putting strategies on because they back tested well. You should be putting strategies on because you understand where that strategy is going to do well and where it's going to do poorly. and you've taken a look at the marketplace and you have determined that this particular strategy is likely to do well in this particular marketplace. So any strategy you have has those winning and losing scenarios. I don't care how complex it is or how many years and different ways it was back tested. Every strategy has what we call a story. So a bull trade, for those of you who may or may not know what that is it's a bullish vertical, 10 delta short, 65 days to expiration entry, 30-point wings, do on the Russell 2000. There's no adjustments, and that's it, right? We entered we exited a certain date, whether it's up money or down money, or if it hits a maximum loss number. So I guess one time to our credit about that. So the story of that strategy, well, put it this way, in order to trade that strategy, if you were going to take that strategy and you were going to trade that non-subjectively and what most people would say non-subjectively, and trade it every single month and just see how it works out. If you were to do that, then you would have to have if you're truly a trader, right, and you know what you're doing and you're not looking at just backtesting results, you would have to believe, well, first of all, you would know that strategy would stop out and it's pretty simple, right? So it's easy to tell. So we're starting with the simple. You know that strategy would stop out if we get a down move that's too far in a period of time. And meaning that this strategy is going to stop out in two types of markets. It's going to stop out in a downtrending market, and it's going to stop out in an extremely volatile market, and it'll also stop out if we get a larger than normal pullback at the top of a market. Okay, those are the scenarios in which this trade is going to lose, and that's pretty clear. And if I understand that and I'm going to trade a bull strategy, I should be trading that because I have an underlying belief that the market is likely not to come down to my stop out point for the duration of that trade, right? And if I'm going to do this every month, I would have to have the belief that the market generally doesn't do that most of the time. And also I would have to have the underlying belief that the market generally uptrends, which I do have that belief, by the way, most of the time. So that being the case, this is a very good strategy most of the time. The problem comes in is is in that trade, you understand your losing scenario, but what people do is they try and hide that losing scenario by going into, say, a broken wing butterfly. They say, hey, if I go into a broken wing butterfly and I'm 0 delta and I put in an adjustment strategy, now I don't know when I can really lose. Right? I'm not, in other words, it fades their ability to tell when that trade is going to lose. And then they rely on back testing to tell them that it's okay. The reality is, if you're trading a broken wing butterfly with any type of certain adjustment strategy, you should know exactly what has to happen in the marketplace for that trade to lose, just like we did with the bull trade, just like we did with the stock. That should be blatantly aware to you. And once you're aware of that, then you can look at the marketplace and say, is the marketplace likely to produce a scenario where this trading strategy is going to lose? Or is it likely to produce a scenario when this trading strategy is going to win? Then you can make a conscious decision on the probabilities of you winning and decide to trade that strategy or not decide to trade that strategy, or to modify adjustment points and so forth. Okay, so my point being that every trading strategy has that story, and if you're simply hiding it from yourself, then you're not doing yourself any favors, right? You're just pretending that you can't lose. Now, one of the things that we did in the workshop is we talked about a bull vertical and we compared it to a broken wing butterfly. A lot of people say, well, I won't trade a bull vertical because I'm afraid the market might go down and I'm going to lose. And I said, okay, well, let's take this bull vertical and let's compare it to a broken wing butterfly strategy that has upside adjustments. In other words, the strategy that's entered, so we have a bull vertical which has entered positive delta. We have a broken wing butterfly that's entered flat delta and has a little bit of risk on the upside. Right? In other words, it could lose or it could either lose or not make any money on the upside. So now we have a scenario where we enter the trade and the person is right. If we get a down move right away, then the bull trade is, or the bull vertical is more likely to stop out. However, that's very static thinking, right? That's not thinking through the whole strategy. Let's say the market goes up 100, 200 points to the upside. Well, my bull vertical, I do nothing, right? I'm positive delta, not an issue. My broken wing butterfly, if I want to make any money or if I don't want to lose money, I'm going to have to adjust that thing, right? And if the market's moving fast, I'm going to have to adjust it a lot. I'm going to have to adjust that probably a little bit positive delta. Well, if I do that and the market comes back down to where it was very quickly, my bullish vertical did not lose from the down move. It's doing perfectly fine. Some time went by, I might actually be up money. My broken wing butterfly that's supposed to protect me from the downside has now created a situation where I'm down a substantial amount of money or I've lost because I didn't make any money on the up move. And now I lost money on the down move. Now I might be able to adjust my way so that I don't max loss out, but one trade is in critical condition or lost, and the one that's supposed to protect me from a down move. Okay, so my point being is you need to think through your strategies and think about the fact that all you did was hide your losing. All you did is change the timing of where a down move would be problematic by going into a broken wing butterfly. You didn't change the fact that you're still vulnerable to a down move. And you're going to find that no matter what you do, it's going to create a vulnerability somewhere. Now, some strategies are more dynamic than others. That's true, but they all have this vulnerability. And it's fine to trade any strategy as long as you're aware of what those are, but you shouldn't be trading any strategy where you're not blatantly clear about what has to happen for that strategy to lose. Okay, let's talk here. What I want to do is I want to show you something really quickly here. It's 11:38. So this is a bull trade. And I'm just going to ask a couple of questions about this. We talked about losing scenario in this, right? Just so everybody knows, this just happens to be a 7 lot. We took in about $2,000 of credit. We're going to have a maximum loss of about $2,000. We do 1-to-1, and there's no adjustments. So basically, if the market comes down to, and we'll just take out implied volatility, right? If the market comes down to about 1440, then this trade is going to max loss out. We have another trading strategy known as a Super Bull, which we do on the SPX, but here, let's see, I'll probably do 2 contracts. But here is what that looks like. So we have a market at 1552, and we have a vertical here, and we'll just do a call vertical with the long at 1560 and at 1580. And I ask people a lot of times, which trade has higher probability? And if you want to answer, you can. But which trade has higher probability? Which one's more likely to win? And what they'll tell me is they'll say, well, you know, this is a 10 delta. Well, first of all, these both have the same profit potential, right? They both have the same maximum loss, which is like right around $2,000. Consider that I can lose a lot more than my maximum loss on this trade, because what we call the structural risk in the trade in a bull trade is much larger than a Super Bowl. In other words, the market might come down to, I don't know, 1445, right below my maximum loss. It might gap down. Well, what's the Russell gapping now? 50 points the next day. And next thing you know, I'm down $4,000 on the strategy. Certainly happen, right? That can't happen on this one. That can't happen because the market could literally go to zero and I only lose about $2,000. So this one has, this bull trade has a stop out point. This one does not. I could also make about the same amount of money if the market goes up. Okay. Most people would say that this is a 10 delta, and this applies for condors and all this other stuff too, right? They might say, well, this, yeah, we'll just estimate this as a 10 delta short strike. And you'll hear people say, well, this has a 90% probability of winning. That's complete bullshit, because you can't let the market go down to here, right? Not only that, it's probability of touching. It's not probability, right? If you touch that, you have to stop, you know, say that was your stop out point. If you touch that and you had a stop out point at the short strike, for example, then the probability of touching that is much higher than 10% statistically. Okay, the actual stop out point here is going to be somewhere around here. What's the delta of the option at 1440, which is a more realistic point? It's actually closer to what, 27%? So if we're looking at that number, now this only has maybe like a, I don't know, 70% chance if we take the expiration in the money theory that most people say from trading, right? It only has so it's got a much less chance of winning, maybe 70%. If you take a look at probability of touching, which is going to be much higher, the probability of touching that point is even higher than that. So that puts you down to maybe a 60% probability of a win for the strategy. Now, it is true that you are going to gain a little bit more distance as time goes by, okay? But it's still, my point being, the probability of you winning this, at least the statistical probability, is actually much lower. The actual probability of this, effectively, by the way, if you traded this from 2002 till today, this wins 75% of the time, almost exactly. Okay, so that's the actual probability of this strategy winning with that stop out point, and the way the market's been in the last 20 years, about 20 years. You take a look at this strategy, people will tell you that this is a very low probability strategy. And if you're using the delta, that means it's got, what, a 55% chance of failing. Okay. The good part about this strategy is that, again, we do nothing here, right? There's no adjustments. The good part about this strategy is I cannot lose more than what I expect to lose, because my structural risk in the position isn't 27 or isn't almost $20,000 like this one. My actual structural risk is my maximum loss. That means that the market can go down forever and I don't have to stop out of the trade. Meaning that if the market goes down a lot and then it comes back up, which I know never happens, right? It happens quite often in historically, then this strategy doesn't stop out and it may even win. So my question in one strategy, so in the regular bull strategy or this blue strategy, is the market going to go down enough to stop me out for the duration of the trade? Where the question in my other strategy is going to be, in 65 days from today, at some point, is the market likely to be higher than it is now, or higher than 1572? The effective probability historically from 2002 forward on our Super Bowl trade is actually 86% win rate. This strategy actually has an 86% win rate historically. Actually, I can go back to 2011. So let me just go to, I gotta go to reports, right? So if I go to reports and I go to account for our Super Bowl from 2011 forward, and I go to our charts here, this strategy has a win rate of 87%. This is a simple strategy. You put it on, you take it off. That's it. Win rate of 87%. That's insane. And I believe it's over 85% all the way back to 2002. It is, now I'm not trying to sell a strategy, right? This is something free we offer in our FIT program, but I'm just trying to show you the difference that the actual bull trade from 2002 forward is about 75%. It has a lower win rate, at least historically. We don't know what's going to happen in the future. It has a lower win rate than the Super Bowl, which theoretically, from what a lot of people say, actually has this is supposed to only have a 40% chance of winning or something like that, right? So what a lot of people tell you and a lot of the assumptions that people make as it revolves around income trading is completely wrong. And if you go by those assumptions and you go by that type of a thing, then a lot of times you're making the wrong choices because your assumptions aren't there. So if you understand the dynamics of the strategy and you understand that most of the time, 2 months from now, or a vast majority of the time, I would say 86% of the time, or 87% of the time, 2 months from your entry date, you're going to be at a higher level than you are today in the marketplace. If you go by that assumption, then this trading strategy is something that's good for you. But in either strategy, you should understand that, or let me just point this out. This strategy historically does fantastic, but you shouldn't just go by the back testing results and say, I'm going to take that strategy and I'm going to trade it every month now going forward, because that strategy has a losing scenario. And it has a scenario where you will have multiple losing trades, possibly for months or years of losing trades. For example, if the market goes in, if the market situation changes to the context where it's no longer uptrending over the longer term, and we're getting a year or two years of downtrending, where the market two months from today is lower than it is. If we go an extended period of time like that, this strategy is going to get murdered. So as a trader, you could trade this strategy pretty much what most people would call non-subjectively. And if you did that for the last, I don't know, 10, 15 years, you'd have done fantastically well. That has nothing to do with whether this strategy is going to do well going forward. But if you understand the dynamics in the marketplace that are allowing this to play out, and what has to change in those dynamics for this to continue to play out, or for this to turn into a long-term loser, then you can do things a little bit differently. If I were to share the results from this year so far, this Super Bowl, like I said, is actually up 240-something% on our planned capital. Of course, you can't trade at full size because you're taking a full loss, right? You can't trade at full size because you're losing everything you have in the trade. So you have to limit your size. I trade at 1/10 the size I would trade a normal bull trade. That way, 10 losses equals 10 losses in the other trade, right? It's from an account perspective. So you'd have to kick those numbers down. It's really more like 24% if you're actually doing a reasonable size. But still, a fantastic strategy here. As far as performance this year, that was 249. This bull vertical lost money this year. But you say, John, the market was up. The market was bullish this year, except for 2 months. And I would agree with you. The market's been extremely bullish this year. It was bullish early on coming in, and it's been bullish since March, extremely bullish. But the problem is, one of the problems with this blue strategy is that it has a stop out point, and that stop out point keeps getting triggered because the average true range or the cycles are too big, and the entry timing happened to be whenever we entered the trade, or not whenever we entered the trade, but a lot of times when we entered the trade this year, we were at a point where we got a 100 or 200 point down move in the Russell, stopped me out, and then the Russell returns, and then ends up being higher by the end of the cycle. Very, very frustrating, right? But also very, very predictable. It doesn't take a genius to see that we're getting these huge down moves or in the middle of our crazy uptrend that we've been in. That is going to stop out that bull trade. It's not going to bother the Super Bowl trade. It doesn't bother at all because I can get my 200 point drop all the way down to here and then have the market be back up here 2 months from now. And bam, there you go. This strategy's only lost one trade. This Super Bowl strategy's only lost one trade for the year. The rest of them have been up. We don't know what December is like yet because we haven't closed in December, but it's looking okay so far, right? This other one's had a lot harder time. And the reason is because of the dynamics of the strategy. So this is something really to think about, because what a lot of people believe and what a lot of people are taught about these types of strategies, just looking at the bull trade, I would imagine that some of you are surprised that strategy, that Super Bowl, has that kind of a win rate. And you'd be equally as surprised to take a look at what a lot of people are trading right now and the assumptions they make with their butterflies and broken wing butterflies and calendars, especially, my God, calendars. Don't even get into that, but they make these assumptions about these strategies, and the assumptions are completely, like, they're way off base, and that can lead to confusion and so forth and things like that. So I was just pointing that out. And it doesn't look like we have any comments here, so we'll move on. And let's see, what time is it? It's 11:50. So learn to quickly evaluate any trading strategy. It's a very important thing to do if you want to become a truly confident trader. You don't want to use back testing and recent results as confidence for your trading, because when you do that, I'll go through what happens. I back test a strategy forever, I form fit it to the market or whatever, and I prove to myself this strategy is going to work now and for into the future. Well, actually, I'm not quite convinced. So I'm going to try this strategy with some money, right? So I'm going to try this strategy. I try it with a small amount of money. And of course, if it fails, oh, that strategy is really crap. I'm going to go do something else. That's actually the best thing that could probably happen to you if that's your mindset, by the way. If the strategy does well, I'm going to trade it a little longer and see if it still does well. If the strategy continues to do well, I'm going to add money to it. A lot of times people will double their size. If they happen to hit that strategy where it gets a 6-8 month or a year and a half winning streak, which happens, right? We're in high probability strategies. They win 80% of the time. If I happen to hit that cycle or get into that cycle where I've won 80% of the time, what do? I scale up like crazy. Why? Because I'm basing my confidence off backtesting results, and I'm basing it off my recent results that I happen to be getting in the strategy. Even though backtesting results are form fitted, I don't give a crap what trade it is. If you fine tune your strategy, it's form fitted. Recent trading results are highly dependent on luck. So now you have a form fitted strategy that you've built your confidence on, and then you've increased your confidence through random lucky results, and you're trading this huge size. Now, even if the trade does have an 80% win rate, which is very possible, right? We have strategies with 80% win rates. We just showed you one. So it's very possible. So I'm trading this trading strategy that now I've kind of dismissed the possibility that I can lose, because now I'm overconfident in the wrong things, by the way, on the luck on the luck of the draw that I've gotten over the last 6 months or a year. I'm oversized, and then the normal thing plays out. I get one of those normal losses. Then maybe it's an extra hard hit, right? Maybe I take 1.5 times maximum loss because maybe the market's, it's been so favorable for a while. Sometimes when it breaks, it gets kind of nasty, right? So now I take my 1.5 times maximum loss on a big trading size, and now I say, oh look, I've traded for the last 16 months. I've traded this strategy, and I lost money. And you go back, and if you looked at this from a percentage standpoint, right, you made, I don't know, 10%, 10%, 10%, 10%, 10%, you had a loss, you lost 15% because it was a 1.5 maximum loss, to say. Or maybe you're making 5%, 5%, 5%, and you lost 15%. Still, good return over maybe that period of a year from a percentage standpoint. But now you've lost money because you started trading with $10 and now you're trading with $1,000, and you've been making 10, 5% of $10, 5% of $20, 5% of $100, 5% of $200, and then now 15% of $1,000, and now you're down money for the year. Nothing went wrong, by the way, with the strategy, right? This trading strategy sucks. I've been trading it for a year and lost money. Your confidence is shot from a completely normal situation, meaning that what are you going to do? Well, I'm going to reduce size, right? So you go back and you start trading small again, or you switch to another strategy, and you do that same process over again. And this is what keeps traders in this loop for decades of trying to make money trading and not really getting anywhere. It's because they're just constantly going through that process. And what we try to do is we try to break that process through and not having people rely on recent trading results and back testing for confidence, but have them rely on self-confidence or confidence in themselves, that they understand the strategy, they understand how it's interacting with the marketplace. Because when you do that, if I'm trading this strategy and I'm trading it because it looks like it interacts with the marketplace, and then the marketplace shifts during my trade, which happens, and I lose that strategy, we both lost, right? You lost because you lost and I lost, but your confidence is shattered because now the strategy, you don't understand why really the strategy lost. It's a shock to you. You weren't thinking about it losing, right? And you don't really know what to do because, what if it loses again? And what if the market's changed now and this strategy isn't profitable anymore? All these questions come up and the confidence just gets blown apart, and you're not willing to go into the next trade. Where if I completely understand what's going on here, I have this strategy, oh, the market shifted, I lost a trade. I'm like, oh, okay. So my question becomes, is the market environment, has it changed in a way where this strategy is going to be problematic trading? If it hasn't, in other words, it may be just a short event, and it's just just a blip on the radar, you can continue on going on that strategy. Or I can say, yes, I believe the market this is a change for the marketplace, right? This is a difference, and then I can apply a strategy that I know will do well or modify my strategy in a way where I know it will do well in the market going forward. Right? Because you couldn't have back tested 2020. You couldn't have done that because this never happened before. But if you understood the dynamics, you could have seen this coming. When we get the big down move with the range expansion, when we broke the major support level, right? Those were all warning signs, warning signs, warning signs. The market's changing. this type of strategy that may have been working fantastic in, the run up into January and February is no longer going to be viable for this type of market speed. And then I can say, well, what type of strategy is? So I may have been doing a bull trade. I mean, just take something simple, right? We don't have to be complicated. I could have been doing a bull trade into January and February. Would have been perfectly fine. Wouldn't have been an issue. I see that type of down move. I can swap over into a Super Bowl because I know that kind of volatility, even whether the market's up or down, isn't going to be any good for my bull trade anymore. Super Bowl, yeah, the market's going to be up in 2 months, but chances are this crash is going to alleviate itself at some point, right? So I can be taking a very well-defined risk, and I can trade my Super Bowl, and then I can, do well the rest of the year when the market bottoms out and we recover. Because we all know when the market comes down really, really hard, most of the time, it's going to have a V-shaped recovery because the government's going to step in, something's going to happen, right? And it's going to shoot back up, which is pretty much what happened here. So those are just some things that that we're talking about. And just I guess to close up here, because I guess we're at an hour. Check out our Trader Transformation Workshop. It's really cool. You go over to lockeinyoursuccess.com and you can do that. And check out these free resources, and hopefully they help you out. All right. This is what I
Hey,
have,
John.
Tom. Yeah.
Yeah. Did you see the chat? Jay had a question at the end. Would you call most of your strategies single-sided despite being delta hedged? He's got actually a couple questions. Maybe it's easier for you to read it.
There are. Let's see. Would you call most of your strategies single-sided? No. Well, some of them are, right? So we have bull, super bull, which are obviously single-sided. Most of our broken wing butterflies take less risk onto the upside than they do the downside. Bearish butterflies are the opposite, right? They take more on the downside. Rock trade is going to be different, right? So a rock trade is an adaptable trade. So when the market is moving a lot, it's got one-sided risk. When the market is relatively flat, it takes two-sided risk and tries to maximize our theta gains and stuff like that. So I think that might do that. So let's see. It seems like if the market goes down too quick and out of the tent for a call hedged fly, you're going to defense.
Your go-to defense.
Go-to defense is to move the entire position that can't be Harvey'd, which amounts to locking in a loss or changing formation. In your courses, do you teach alternative defense tactics to handle or mitigate these situations? I'm not sure I fully understand the question, but I am of the opinion that I let trades lose when a trade is going to lose. So I would suggest that in order for most of you guys to progress, you get away from this notion that I want to hedge my strategies all the time, or I'm trying to maximize my win rate. A lot of these strategies that maximize win rate, it kills their positive performance, and then when they do take that big loss, they don't have the gains to offset it. So I'm much more into take your punishment when it comes, and trade the appropriate size, maximize your profits along the way. That's more our theories. So hopefully that answers the question. I'm not sure.
Then he had another one. Most of your strategies are hedged with an in-the-money call. See that?
Well, how do they say most of that? See, I don't even get that, because I have one strategy that's hedged with an in-the-money call out of 12 primary ones and 50 other ones. So yeah, we have a strategy, the M3, the classic M3, and we also have a X4 version 22, both usually use an in-the-money call. The spread on those in the money options can often be the size of the entire profit of the planned strategy. Okay, so this is a good question. Yeah. Do you think that the execution poses a substantial risk of success? Have you considered hedging straight hedging with a future or some stock instead. Yeah, so depending on the market environment, by the way, too. So sometimes the call's in the money, sometimes it's out of the money in the M3. It's not always in the money, but in a low implied volatility environment, it is going to be in the money. And you will get, if you know how to price the call, it doesn't matter what the spread is. It'll fill at a reasonable price, and you should know what that reasonable price is if you understand what the intrinsic value is, right? So if you have a call with 100 delta, we'll just use that for an example. You should know what that should cost you, right? It should really have almost no time premium in it, and you can determine what the intrinsic value is of that call based on how far in the money it is. So you could just do that quick calculation, and you could know. I mean, you don't have to do that because you could. I mean, you just price it, and you fill it at a reasonable number somewhere in the middle of mid price. But you could do that if you wanted to do that if you ever had trouble at some point with that. But I don't worry about bid-ask spreads even in the least. So as far as hedging with a future or a stock, you can do that, right? So we had initially the M3 was actually hedged with IWM stock. So that's something that can be done. You could also hedge it with a future. There are inherent risks in that, right? So one of the good things about a call, if you get into like a 70 or an 80 delta call, or even 100 delta, I mean, we don't go to 100, but if say you get into an 80 delta call and you get a really big down move, you have some implied volatility that comes into play, and you have that offsets your losses to the downside. In other words, if I did it with a future, I have a straight delta. No matter how far down the market goes, I don't get any implied volatility kick if the market comes down, and my risk essentially is unlimited in that future. I'd much rather have a call on that has some implied volatility factor to it. When implied volatility goes up, it hedges off the losses of the call. So I would prefer that. If I was going to do a future, I would hedge off the future with a put. So in other words, I can buy a synthetic in the money call by doing the future and then buying an out of the money put, so that if the market does come down, it hedges off the losses of my future if I get some sort of catastrophic move in the market overnight. But I certainly don't like the unlimited risk that futures bring in to play. So.
Well, the futures also have problems that they're trading when the regular market's not. So you have like the 2016 election where futures were limit down overnight, but by the time the market opened, they were back to where they started.
Right. Yeah, you have that issue going on too, and that can freak people out with their position. And one of the worst things, it's funny, you have an income trader who comes over to income trading because they're having trouble determining which direction the market's going to go. Right, a lot of our traders do that. Right, say, well, I wasn't successful in directional trading, so I'm going to come over and I'm going to be non-subjective and I'm going to do options trades. And all of a sudden, they become an expert in day trading a volatile futures environment overnight when the futures drop. Right, in other words, they're going to jump in, they're going to do something. If you're going with the premise that they really don't understand how that works, what are you even doing trading that? Because all you're going to do is you're going to do something usually that's going to cost you a lot of money. And
Right.
we saw that even in 2016, people jumping into futures. I was actually we have a seminar called Trading Triangle. We did that in Hawaii, and we were there during Brexit, and we talked about this. We saw people lose a ton of money playing with that. So just be careful with it. If you're not an active day trader, you don't understand futures, short-term futures movements, don't play with that, right?
And it's playing with dynamite.
Exactly. It's crazy.
Then Jay had one more question about, let's see. Posted on the forum, to get a really nice call hedge fly, you might require 140 to 200 points in the width these days. Do you adjust it in this way, or do you manage more actively? My real question is, do you prefer a wider delta and low gamma setup these days, given current fly pricing?
Right. So this is another common thing that people think, right? So they think that, hey, the market's moving more, I want a wider butterfly. And that's actually, if you're having like crazy implied volatility things going on, you actually want to be in a more narrow butterfly. So I'm in more narrow butterflies right now. Like our version 22 is the type of trade that we play on implied volatility, where if the market movements are bigger, we tend to go wider, and if the market movements are smaller, we tend to go more narrow. And that's good for a more normal implied volatility market. But when you get into a wider position, you're actually making a bigger position too, by the way, right? Because you're getting more capital into it. You become more susceptible to implied volatility shifts as you get wider. So if you're having, so it all depends on what you're trying to defend against and so forth. So in this implied volatility environment, where we're getting these shifts of 5 points of implied volatility a day, you'll get stopped out instantly sometimes in a wide butterfly just from implied volatility variances, where if you go narrow, the implied volatility doesn't affect you as much, and you can withstand really, really huge price movements in the marketplace. So we've been, and I've shown this on many different trades, right? So in a membership, we've gone over doing this trade wide, doing this trade narrow, and overwhelmingly in this environment, we are much better off in our more narrow positions than we are in our wider positions. So I've been more narrow. I've cut down a lot of the sizes in some of the strategies for this environment in our 2020 updates. So yeah, and you can go wider. The reality is what I would like traders to do is understand the consequences of going wider, in other words, the benefits and the risks of going wider, and compare them with the benefits of the risks of going narrower in comparison to what's actually happening in the marketplace. So this is an example where we talked about earlier. Sometimes going wider with more price movement is beneficial. Sometimes it's very detrimental, and I found it very detrimental this year in particular. So that's my answer there.
Well, great. And Jay said phenomenal explanation and presentation. So
Well,
great
I'm glad
job.
you enjoyed it. I hope everybody enjoyed it, and I appreciate you having me on. It was, it's fun to talk.
Yeah, it's always a pleasure, John. Have you back again, of course, in the future. And best wishes. Have a good Thanksgiving if you're doing that. I know the CDC is recommending that people don't have big family gatherings, but at least in your own family, you can have one.
Right, exactly. Yeah, hopefully this is going to be an interesting round of holidays, isn't it?
Oh, crazy. Yeah.
Yeah.
All right. Well, thanks everyone for coming, and I'll get this posted as soon as I can. And again, thanks very much for the presentation, John. It was really great.
All right, thank you. Have a great holidays, everybody.
Thanks. You
Bye-bye.
too. Bye bye.